Now, one of my first jobs in finance was working as a stock exchange automated trading system operator, a seats operator. So this was a newish type of role, which had come about due to the digitization or the uh, electronic transformation of the stock exchange. So prior to that, we used to, stand in pits and yell at each other with weird hand signals, and then we figured out that doing it electronically was much more efficient. And so my job was to do those hand signals, but in a digital or electronic format. So essentially, I'd have stockbrokers yelling at me all day, telling me to buy and sell different stocks through the system that was linked to the stock exchange. Uh, Now, at this time, when I was just getting started out, the this is quite an exciting time for stock markets. It was 1999, and as if anyone remembers some history lessons, ancient history lessons, in 1999, this was the peak of the .com bubble. In Australia, one of the things that Australian investors were looking at was the uh, the ASX 200. Well, I think at the time it was more the All Ords, was hitting 3,000 index points in the US. I think the Dow was getting up to, I think at the time was 10,000 points at the same time. But yes, kind of overshadowing that kind of hype was this .com bubble. And every seemed like every couple of days or so there was some new tech stock being issued. Now this was Australian stock markets, but in the US and the Nasdaq in particular, there was new tech stocks coming out every single day, it seemed, and many of these, no one knew really what they were doing. The internet was still new. The opportunity set out there was still kind of vague. Everyone trying to take advantage of something or other, and so investors didn't know what was going to hit or not, and so they're just buying everything. Any company that listed, everybody wanted some, and so yeah, you saw a big run of investors into these tech stocks, and this soon became the .com bubble. That is, if investors in particular are investing without a fundamental reason, or in particular without a fundamental idea of where value should be, and they just keep on buying, the point is to buy rather than to buy at a good price, then prices can get out of hand. And they definitely did that during this period of time. Of course, that all came crashing down in the year 2000, after we survived the Y2K bug. But there's this sense that this uh, tendency we have where we don't want to miss out on things, right? FOMO, right? That is, if everybody's is in this thing and investing, and well, maybe we should just be doing it too. Now, this is a big reason why we see these bubbles form. We've seen, perhaps some of these bubbles forming in cryptocurrency markets as well more recently. But yes, fear of missing out is a big driver. If all your mates are getting rich off of these things, then I better jump in too. Yeah. Uh, but when it finally bursts, we see perhaps a flight to safety, and in particular we see um, this unraveling of all of these trades that maybe were carried out for reasons other than the economic. Uh, Now, other than FOMO, there's another component here, another type of, I guess, behavioral bias that we see in these types of situations, and that's herd behavior. That is, it's not only a fear of missing out, perhaps, but it's also a tendency towards safety and security. That is, we follow the herd. Yeah. If everybody's doing that thing, maybe that thing's the right thing to do. Maybe that thing's the safest thing to do in particular. And so maybe it's a good idea just to follow everybody else, right? But in general, we have these behavioral tendencies, fear-driven perhaps, but also maybe just cognitive preference. That is, instead of me doing all the analysis of what stocks I should buy, maybe I'll just follow what everybody else is doing. Everybody else probably doing analysis, right? And maybe I'll just do what they're doing. Now, in particular, this type of behavior is a market-moving behavior. A lot of other behavioral biases we have in the investment world, that is decision making, which is somewhat irrational, that is not necessarily governed by the economic, which for most, investing, it's an economic reason why we invest. But when it's not economic, often, the tendencies that push us away from the economic are not unidirectional for everybody. That is, every individual might have a different bias and might make them make a decision that is different from another person. So some people their bias might get them to buy a stock, others it might get them to sell the same stock. Yeah. So those biases, a lot of different behavioral biases, aren't directional, or where individuals are all moving in the same direction. This isn't the case for herd behavior. This type of bias does lead to everybody moving in the same direction. And this is why we get these bubbles, and then on the flip side, why we get panic selling, and we get these bubbles bursting and market crashes. And from a investor point of view, yes, we need, from individual point of view, perhaps we need to be aware of these types of situations and try not to get caught up in the exuberance, let's say. But perhaps we can also take advantage of this type of thing, and this is what hedge funds try to do. A lot of hedge funds, especially a lot of quantitative hedge funds, they try to measure this, what we call momentum. In particular, momentum, which is often driven by these human behaviors, and look for signals of when there is this herd behavior taking off, when there's momentum building in a different stock, or other type of security like cryptocurrency, for example, and looking to buy as this momentum is picking up, and then looking for the trigger to sell. When should we get out of this trade? Because sooner or later, anything that is driven by this herd behavior generally will meet a quick end, quick and sudden drop, let's say, a bursting of the bubble. So so we do see a lot of investors looking to take advantage of this. A lot of technical analysts out there. This is what they're trying to model, really, just this human behavior that leads to these patterns, in particular patterns of momentum. So yes, individually we should look out for this type of behavior. Maybe we shouldn't be driven by fear of missing out, for example. Maybe we should do our own analysis in order to figure out what to buy and what not to buy. But this can be difficult because at times, and as we've seen with a lot of different bubbles, they can last a long time. And while we're on the sidelines saying, well, no, my analysis says that this it should be valued a lot less, this herd behavior can last for a long time, and we can miss out on a lot of that upside.